Welcome back to another video here from P2P Empire on tour. Today I will be visiting the Getincome marketplace, which is a rather new platform where you can invest mainly in short-term consumer loans from Indonesia. I'm not sure about the exact plan today, but I will definitely be speaking to the CEO, and my goal for today is to find out whether their enhanced protection schemes are worth it or whether it's just a marketing gimmick. As always, this video is not sponsored. P2P Empire is covering all the costs. If you would like to support our channel, you can support us at buymeacoffee.com/P2PEmpire. Also, there is going to be some exclusive footage only available for members, which you can also access on buymeacoffee.com/P2PEmpire. All right, so we got about 30 minutes until our meeting. So let's see if they are located at the address, which is also listed on their website. All right, I think we are at the right place here. The address should be right here. This is the building. Also, it seems to be in the financial district. That's where Estate Guru is located, in a building behind this. Here's EU Tech Credit, which you might know from Mintos. So let's try to find the entrance. Okay, here we are at Terminal 5 Business Center. It should be the 3rd floor. Let's try to get up. Upon arrival in the office of the Getincome marketplace, I got greeted by the CEO and the team. They just moved into a new office space, so let's have a look at where Getincome is managing your money.
Hi, welcome to Getincome. Come on in. We recently moved to a new office, so our office is still in development, but I can show you a little bit what we have. We are very excited about this new opportunity to be in a new place. Right now, we are most of us together. Before, we had a lot of spread out offices everywhere. So it's a great place to be. We're excited. So come and join me. On this side, we have 2 conference rooms. Right now, we have one gentleman here waiting for us. I'm actually in the middle of a meeting, but I wanted to spend some time with you guys first too. And this is where the magic happens. We have our coats, and Estonia is still very cold. And even we have coats for our little dog. See, we are pet friendly. Come on in, guys. As I mentioned, since we just moved in, our kitchen was just delivered yesterday. So we are excited. As you can tell myself, I'm very excited about having food nearby. So I'm excited about being here at work with the great kitchen, which is here being ready to be built. So eventually we'll be here in this section right here. And of course, in the meantime, we'll get to spend some time here on the coffee machine and gossip about the new adventures that we have coming with Getincome. Another showroom here, another actually what's it called, a conference room. We have a meeting going on. And here's where compliance, here's Hendrik, where compliance basically takes care of all you guys, and by approving you and allowing you to come and invest in our platform, as well as our CEO. One of the things I love about this company is that our CEO is with us at all times. One of the things that I've learned back in Latin America, where I'm from, is that the CEOs have always this distance between employees. But here, we're all a big family, we are all together, we sit at the same tables, and we enjoy the growth of our company together. And this is, of course, where I sit, where the magic really happens, I will say. So come and join me. I want to show you where marketing and legal actually works, as well as operation. And we can see our brilliant CEO there. Don't you love that smile? I mean, really. And we have Archie, our mascot. He is very smart. He likes to invest as well. So his father also does that very much. Legal section as well. Operations, Lavrenti, one of the best guys that I ever met in my life. And the most beautiful marketing sales manager we have here. Not only because she's the only one, but she's also very talented. And I mean, this is, as I said before, guys, it's a very quick walkthrough of what we go to every day. We actually have about 4 or 5 more, I think more than 4 or 5 of our co-workers working abroad and also in different offices in Estonia. But if you guys ever feel like coming to Estonia and joining us for lunch, coffee, or just get to know more about us, you're more than welcome to come and join us at any time.
After the office tour, I sat down with the CEO Kimmo Rutkunen to talk about the platform's development. Kimmo has been in the lending business for 14 years. He has founded and sold multiple fintech companies, which makes him very experienced in the lending space. He's also a passionate investor in P2P loans. When the COVID hit and lenders started defaulting, Kimmo realized that the offered guarantees on even the largest P2P marketplaces in Europe were not good enough to protect investors' interest. That's also why he decided to launch a more secure P2P marketplace with
enhanced safety features. I also asked him about his expectations when launching a new platform in a somewhat saturated market. He shared with me that his expectations were much higher than the achieved goals so far. While lending money to borrowers is easy, getting trust from investors is much more challenging. Income has grown steadily in recent months despite having a somewhat slow start. The platform aims to provide stable interest rates with additional securities. That's also why the interest rate is capped at 12% per year. During our talk, Kimo shared with me that he doesn't want lenders to compete with cashback bonuses like it's the case on other marketplaces, as previously investors who got attracted by those increased rates lost money as the lender went bust shortly afterwards. A 12% annual percentage yield cap is also something that lenders are happy to pay in the current market environment. Since Income is not the only marketplace where you can invest in loans, their lending partner Dana Rupiah is also funding its loan book from Bonster and Mintos. So let's break it down for you to understand the difference between Income and other marketplaces. So Dana Rupiah, for example, is offering unsecured consumer loans from Indonesia. The company uses free marketplaces to fund a part of its loan book. Income lists those loans for a 12% annual yield while demanding 35% junior share from the lender. Bonster offers a 15% annual yield and demands 10% skin in the game from Dana Rupiah, and Mintos is offering 16.5% interest with the same skin in the game. Those are at least the terms at the time of recording. Now, every platform is publishing some type of ratings which may represent the quality of the loan book. The better the loan book performance, the lower the junior share on Income and the higher the ratings on Bonster or Mintos. So by reviewing the table, it's pretty easy to determine who offers the highest yield. What's different, however, is the security that comes with your investments on Income. The platform promotes a 35% junior share, while Bonster and Mintos are asking for just 10% skin in the game. But what's the difference between those two securities? The offered buyback guarantee protects you from the borrower default, but what if the lending company goes bust? In that case, we have to understand the difference between the skin in the game and junior share. So let's say that a lender's portfolio worth 1 million euro with a 10% skin in the game defaults. In the next step, a collection company starts the recovery process. Let's assume that 40% of the portfolio could not be recovered, which means that 60% of the loan book is the final value that will now be distributed proportionally to the lender and the investors. In this scenario, investors would lose 46% of their investments. 40% is bad debt and 6% goes to the lender. That's basically how skin in the game works. Now let's look at the junior share. The lender will list a 1 million portfolio on the platform, from which 35% is reserved as junior share. That means that only 65% of the portfolio is investable by the investors. What's important to highlight is that junior share is subordinated to investors' funds. Let's have a look at what it means. Let's say that the lender goes bust and the collection agency cannot recover 40% of the loans. That's not all too bad, as investors have invested in only 65% of the loan book. The junior share will be paid first to investors to cover the obligations before paying anything to the lender. So in this case, investors get all the recovered funds, which results in only a 5% loss for investors. That's a pretty solid protection mechanism that significantly reduces your risk of losing money if a lending company defaults. Now, you might wonder how the junior share percentage is calculated, how it works in real life, and what happens if the lender decides not to pay anything after it defaults. So let's tackle every single topic one by one. The calculation of the junior share is very straightforward. First, the platform analyzes the performance of the lender's portfolio. By the way, this is confidential information, which is not being shared publicly. The loan performance analysis is the crucial element in any due diligence process, as it gives you an idea about the cash value of a portfolio within a specific time. So let's assume that we expect to receive 120% of the portfolio back within 3 months. This amount also includes the interest and fees that borrowers are paying. In the lending business, this variable is called the expected repayment coefficient. So to figure this out, the platform has to have access to the loan book performance. In the next step, Income Marketplace has to figure out how much is the required repayment coefficient to cover obligations towards investors. That includes loan principal, interest rate, and fees for the platform. Let's assume that it's 104%. So now the platform knows how much is required to recover and how much is expected to be recovered based on the loan book performance. In the third step, the platform deducts risk margins. If the lender defaults, there are some risks that you won't be able to recover everything. A risk factor could be that the borrower decides not to pay, the exchange rate changes, or a global pandemic starts and borrowers lose their jobs. The Income Marketplace will calculate every risk margin separately, and it's never the same for all lenders. So now the platform can calculate the investable amount by subtracting the risk from the expected repayment coefficient. In this case, investors will be allowed to invest only 79% into a loan, and they would be fully covered if all potential risks materialize. The cash flow buffer is the difference between the investable amount and the expected repayment. A side note worth mentioning here is that Income recalculates the junior share every 6 months or when the product and its pricing change.
We do an update due diligence on this one and see what the junior share around 6 months to the cooperation. The other thing where we look at it is if the loan originator or the loan company, if they, for example, want to have another product coming or they want to update something like pricing or something, then we need to, anything that affects the cash flow from the loan book that we've analyzed historically, then if that changes, like they want to change drastically pricing. That happened in Indonesia, just that, APR cap came down, so the interest rate cap came, and they needed to adjust the product from short-term loans to short installment loans. So then we took another look and updated all of these. And of course, in that case, the skin in the game, or in our case, junior share, that also gets adjusted.
Let's hear how the junior share works in real life.
All right, in the case where we have another black swan event happening or some kind of extraordinary risks which you did not calculate in, and the loan originator defaults, you have certain structures in place to be able to take over the loan book, right? Can you perhaps share more details on that?
For example, if I take Indonesia now, so what we do there is we have the junior share. Of course, everything is in the agreements, basically saying that the junior share is subordinated to the investor amount. So let's say we go there, we take over the portfolio. What we've done there is we've also agreed with a local collection company that they will act as a backup servicer. So effectively, we do get the data from the loan company. We pass it on to and of course, if you remember, we have the actual status of all of those loans in our own system, so we know what's the status of those assets. Then effectively, we pass it on to a local collection company, and they would start collecting. Now, always, of course, and this is also where it comes to the management, right? I guess everything can be fought in court to a certain extent, but we've tried to minimize that risk. So, for example, if we look at Colombia is a different structure. We have a pledges there over their book. So there we've agreed it's this way, that they're pledging their book as a collateral, and those pledges are basically notarized. So we don't need to go to court. Effectively, we can just go after it.
Take over.
And then the same, take over. And then the same logic applies that, we pass it on to a collection company, they start collecting on our behalf, and then we will start shuffling the money back to the investors. So it's pretty standard in that sense, but of course it requires, again, talking with the collection companies, figuring out the local legislation, the security structures, others. In Mexico, there's another structure which I think Mintos is now starting to use, which we also took a look at, is a master trust. And that's even better in many ways because the payments go direct to the master trust, from the borrowers. And then if the loan originator defaults, the trustee automatically starts shuffling the money to the lenders. So it's a bit expensive, at least. At
lower interest for investors, right? I think on Mintos at least.
Yeah, but in that sense, that what I mean about the structure, it's a bit expensive to set it up, and we don't have the volumes yet, but that is something we're looking at. So in short, the idea is to take over the assets and then to be able to collect with them through a local partner. And one thing, of course, is, we don't come up with the local structures ourselves here. So we always use local, regional law firms, reputable law firms to actually consult with them on the assignment agreements, on the other things. So while the assignment agreement is under Estonian law and basically drafted here by local lawyers because we're established here, then we still set up the structures with the regional lawyers so that we know that they are as good as they can be.
So as you can see, Income invests a lot of resources to mitigate risks where possible. But what if the lender decides not to pay back without even going bust?
If all the risk materializes or black swan event happens, and the loan originator says, here's the data, but we will not send you the money, what would happen?
So we have in the agreement so-called, I would call it like hard defaults, which are always non-payment. In the case of a non-payment, we would then need to inform them that you have breached the agreement and we have the right to go after the security or after the pledges. Ideally, again, there's investors are saying that, some platforms haven't been aggressive enough. I would rather say it this way, that I wouldn't comment if they've been aggressive enough, but it's of course always better if you find a solution with the loan originator. But I also think that it's important to be able to enforce the collateral if you need it. So then you have the balance of in negotiation, which should be in investors' favor.
So that's how the unique protection scheme works on Income. I also had a talk with the platform's risk manager who ran me through the due diligence and onboarding process. So let's give you a brief walkthrough. First, the platform collects data about the lending company. Typically, the lender has to provide legal documentation, financial statements, loan book performance reports, and explain how they originate loans. In the second step, Income's risk manager analyzes the documentation. He shared with me that the loan book performance and the portfolio profitability are the key factors that the platform is considering. They look at the information from various dimensions and review the lender's financial statements. In some instances, a group guarantee is required if the lender doesn't have a good track record, which could be a case where the lending company is a startup operating under a more prominent financial institution. Next, the marketplace calculates the junior share and submits the results to the management for approval. If the decision is favorable, the lender receives an offer. As soon as the offer is accepted, the platform conducts a sanity check and reviews the loan agreements, bank statements, and loan documents to see if the loans are backed by any collateral. If all goes well, the lender is onboarded and API integration with the company is established, so Income can mirror the performance of the listed loans directly from the lender's loan management system. Every 6 months, the platform runs a completeness check and reviews the performance of the entire loan portfolio, which helps to determine a new junior share. So that's how it works. Now, Income is listing loans from emerging markets, so I asked the CEO about how he sees the country risk in those regions.
Do you consider, for instance, emerging markets like Mexico or Indonesia, like from a country risk perspective, where does it level up, maybe in your personal opinion?
Well, I mean, I think they are good markets. The regulation hasn't caught up there yet. So many times there's an opportunity to do very profitable business. And that, of course, affects then, the ability to operate and to pay interest and so forth. Massive amount of fintechs also coming in from there. So, what we spoke with Jason also, we have a pipeline and the biggest part of the pipeline is actually Mexico and Colombia at the moment. So from a country risk, surely these are emerging markets. You may have currency fluctuations, you may have, political unrest as well. But then again, if you think about it, you get the 12%.
The profitability,
is much higher, even for an investor. Yeah. So personally, most of my book is actually, and I'm investing only on Income these days. So I have quite a sizable book. I'm just doing the blog update on that one. But it's basically split between Indonesia and Mexico, because that's where we have the most loans available today.
It's quite interesting because also I talked to some other risk manager who is having access to all those data, and he's like, I'm full in Colombia,
Yeah.
And it's it's 16% on that platform.
Yeah.
It's also interesting to see how those people who are in those companies have the access to the data, how they kind of think and go okay, I've seen how they operate, the profitability is there, I get 12 to 16%, let's go.
Exactly. No, I think it's again, emerging markets or established markets or not so established markets. You can get hit by a bad LO anywhere. Yeah. And it usually gets, it's a lot about the management and the way they are.
As you can see, Income is trying to offer investors the chance to invest in profitable markets with additional securities that no one else in the industry is suggesting. Investors are also asking whether the platform is regulated, so let's hear what the CEO has to say about the regulation in Estonia.
All right, what about compliance? I know, for instance, crowdfunding platforms, some of them are seeking the European license. Marketplaces, some of them move to Croatia where there is no regulation. Some of them are based in Ireland. Latvia is now regulated on, they have the investment firms, right? How about regulation here in Estonia?
Yeah, so we are not regulated yet. The European crowdfunding regulation came early last year, and Estonian legislator took it upon themselves to start penning the crowdfunding legislation here. The draft bill was established, I think it was released in February 2021, and it pretty much mirrored the crowdfunding regulation that came down from EU. What the regulator realized, or the legislator realized at that point, was that actually the EU regulation is mostly equity crowdfunding and it's mostly real estate crowdfunding. So those were the two things where it was kind of clear that this is easy to take from the EU bill to bring it to the Estonian legislation. And then they decided to split it into two. So effectively, first came the equity and real estate, and they are now in the process of figuring out how do they write the law for marketplaces and also for companies, that fund their own loans and so forth. So this is under works. Mick, my co-founder and our general counsel, is saying that the insight we have is around the end of this year, we would see some sort of progress in terms of the legislation being ready. And then I think there's a 6 to 9 months transfer period during which we need to apply and to be regulated. So I'd say realistically, we will be regulated by 2023, which is not good, because I know a lot of investors are looking for it and are asking, are you regulated and so forth. So that it would be easier just to answer, yes, we are regulated. But today we don't have the opportunity to even to apply.
Yeah. I mean, for regulation, there is always two sides of the coin, right? One investor wants to have a regulated platform, and then the platform gets regulated, and then they introduce, we will be withholding taxes. You have KYCs, you have a lot of things that come with it. They change to financial instruments which are in essence way less transparent than claim rights, right? So it's not like everything is amazing when platforms are regulated, versus from my impressions at least, you really like a technological company that tries to automate and support everything with technology and get the quality data, right? Which is kind of the benefit.
I think like the main point when we saw the draft bill, and I think it's available even publicly in terms of how the crowdfunding should look like or would look like, the legislation, it looks like the Estonian regulator doesn't go to this investment firm thing, which I thought was a pretty extreme way of looking at it. And I thought one other platform that moved to Croatia also thought it was pretty extreme, deciding to move. So I don't think we're going that far. The main things that they will be drawing in from there is basically investor protection, conflict of interest. Those are the main things from an operational, and I don't think we'll have a problem complying with those, because, and when you talk about AML, KYC, then all of that, we have our compliance officer there who already does that, because obviously, the bank that we're banking with, LHV, is regulated, so we need to comply with their AML expectations. So all of that, I think we already have under control. That's not the issue. But in terms of operational things that may change with the new regulation is the buyback obligation or the buyback guarantee. And that's a question mark, at least in the draft bill, it was mentioned that it's caused problems because it's been marketed as a guarantee, and an LO shouldn't be able to give a guarantee to an investor through the platform. So the platform would need to somehow figure out if the guarantee actually holds. And I think a lot of this has come from the, dissatisfaction of investors. Whereas I've said it before, I'll say it again, I think the buyback obligation is the best feature of modern P2P, because it keeps you out of bad loans if everything goes well. Previously when I was looking at P2P back 5-10 years ago and there wasn't buyback guarantees, I was always looking at it that this will not work because the bad loans will kill your profitability as an investor. But anyway, those are like the things that we see from regulatory point. We're waiting to see the bill when it comes.
As we have covered all the risk elements, let's review the liquidity aspect, as there is currently no secondary market available.
When talking about liquidity, myself, as an investor who is investing in P2P loans for a long time period, I have no issues with committing to the long term. But some people, if there is some kind of situation in their life where they need to exit, currently you don't have a secondary market, right?
Secondary market, we have spec'd it. We are doing it a little bit differently than, again, trying to improve on those. Basically, that you would be buying it off. I mean, one of the things was you would be buying it off at a nominal. So that's kind of, buying at a discount, selling at a discount, buying at a premium. I think we will skip that. So we will just kind of make it more like a primary market, because it doesn't, for your average investor, fooling around with the different discounts and other things.
There are speculators in the...
No, and that's the thing, is like the first time I went on the secondary market on Mintos, and I couldn't, and I'm from the industry, but I went there and I was like, which way should I now put the kind of, is it minus or plus?
The filters, right? They're so confusing.
Yes, correct. And then you see always that there's people poaching on these new users, that they, like, I'm selling this at a 5% premium, and then somebody goes and puts the filters wrong and actually buys it at a premium instead of buying at a discount. So that's why we're thinking that in any case, I mean, to streamline and to make it more simple. My wife said to me when she tested the first, or started investing on income, the first version we had, and she said, I could never do this without you, in terms of like figuring out all the filters and how to invest in others. So I got very close feedback on that one. so anyway, the idea is that we'd really try to make it more simple. And I think if we look at our mobile app, that's something where we've gotten closer to the UX that we want to have as simplicity. But in terms of liquidity, going back to that, we don't have a secondary market today, but as I said, it's spec'd, it's going into the development queue. And it is necessary. I fully agree. We had some institutional investors also saying that, there's, for example, Finto Capital, car-backed loans, performance is great, all things good. They're offering 12% because they're small, and we said that, you need to kind of be there with the others, especially because you have 5-year loans. But the main problem is the 5-year loans, because the institutional guys, they were saying like, we might want to stay in for 5 years, but theoretically we would also like to be able to get out.
Yeah.
And that's the thing, is why we think that, yeah, you're right, we need to get the secondary market done. But if you think about, we are now, the last 3 months have been like the growth after this first year of kind of like silent, pretty stable stuff. A secondary market works only if you have enough liquidity. And in that sense, I'm not hurrying with it because, we don't have really that kind of liquidity yet on the platform. But we'll do it ready. We'll probably get it done around third quarter this year, I would assume.
All right, so that's been my visit of the Income Marketplace here in Tallinn. And what were my impressions? This was by far the most authentic experience so far. The team is very professional. They answered all of my questions. The strengths of the platforms are definitely connected to the safety features. The cash buffer as well as the junior share are unique features which I haven't seen on any other platforms yet. The CEO has explained to me how it works, and I've talked also to their risk management team. There are a lot of risk factors that they take into account when evaluating various lending companies. What's probably the most interesting part is how they look at the performance of the loan book, which is very in-depth and very comprehensive. So that's unfortunately not being always communicated in the proper way to the investors. So now let's talk about some of the weaknesses. I think there are really just 2 points to mention. One is that there is currently still no secondary market, so the liquidity of your investments is somehow limited. The second point is that in terms of diversification, there is not so many options if you're planning to diversify, let's say, across 20 lending companies from 20 different countries. So this is still something that needs to be developed, and perhaps in the future they will offer more diversification options. However, from a safety perspective, I think it is safe platform again to use in the P2P lending space, and in my opinion it could definitely be a primary platform for P2P investors in the future. The potential is there, so yeah, if you would like to try it out, you can use the link in the description below to get yourself a 1% cashback bonus on your investments for the first 30 days after the registration. Also, if you would like to be updated on the current developments of the platform, navigate to p2pempire.com and check out our income review. All right, so that's been my visit of the Income Marketplace. If you'd like to see some of the behind-the-scenes footage, you can become a member on buymeacoffee.com/p2pempire. If you like this type of content, you would like to see more, feel free to subscribe. Also hit the like button and let me know what you think about the Income Marketplace in the comment section below. Thanks for watching, and I'll catch you in the next video.